The real story is that gold has not actually risen in price. It's just that it requires 3,300 more dollars just to buy the same ounce, kilo, ton of gold. And what we're about to see is the next pivotal gold price revaluation event, which will once again incentivize every single foreign central bank to race again to swap more dollars to buy the same ounces of gold. What is the question? How many dollars will it actually take to buy the same ounce of gold next year? So a similar 55th year, 175% higher physical price would price the dollar gold at around $8,000 to $9,000. Now, US gold price revaluation will first force US gold reserves to become Basel III compliant.
Seasoned precious metals trader and whistleblower Andrew Maguire takes a very different angle on the state of today's gold market. Maguire points out that, fast forward 54 years after Nixon ended the dollar's convertibility into gold, the metal now trades near $3,300 per ounce, 9,500% higher. Yet in his view, this rise is not because gold itself has gained value, but because the dollar has steadily lost its purchasing power. From this perspective, he raises the critical question: how many dollars will it take to buy the same ounce of gold next year? A similar 175% move on the 55th anniversary would place gold between $8,000 and $9,000 per ounce. Such a shift, he argues, would also compel the U.S. to make its gold reserves compliant with Basel III. Maguire goes further, warning that the Chinese yuan has already moved toward Basel III compliant gold backing, directly challenging the dollar's global dominance. At the same time, the Achilles heel of the COMEX, the exchange for physical mechanism, has come under increasing strain, enabling synthetic paper gold to be funneled into physical, Basel III compliant markets. The result, he says, is mounting stress on the entire dollar-based paper gold suppression system, bringing it dangerously close to collapse. If this structure were to break, the consequences could ripple through the vast $2 quadrillion derivatives market, where gold remains the most significant and pivotal asset. Before we dive deeper into Andrew Maguire's explosive insights, make sure to hit that subscribe button and tap the bell icon so you never miss a moment when truth meets the market. Let's get into it.
Now, the elephant in the room is the passing of the August 15th, 1971 54-year anniversary of where Nixon ended the Bretton Woods system, announcing the suspension of the the dollar's convertibility into gold. Now, foreign central banks were racing to exchange dollars for gold, and what that was doing was draining US Treasury holdings from 20,000 tons to around 8,000 tons. And had Nixon not ended the convertibility, all US gold would have flowed out. So, Nixon's shock, which was, as I say, on the 15th of August, it priced gold at $35. However, this did not stop foreign central banks going to the marketplace to sell their dollars for gold. And the next day, just one day later on the 16th, the price of gold had spiked higher by 25%. It doesn't seem like a lot because it was $35, but it moved up to $43 per ounce. Now, foreign central banks then continued to go to market to swap their depreciating dollars for gold. And by December 1974, the gold price had risen by 450% to $195 an ounce. And with the gold price getting away from the dollar peg, further and further away from the dollar peg, by no coincidence, this was the very month that the US COMEX gold futures market was launched. Now, the COMEX was trading long before that in the 30s, but gold had never been a component of that. But so just to really illustrate, in an uncovered 1974 State Department cable, WikiLeaks revealed that in association with the local London 400-ounce gold markets, the COMEX had deliberately been designed to create volatility in gold prices, and the idea was to discourage US citizens and foreign investors from holding physical gold by making prices far less predictable and at the same time indirectly supporting the fiat currency stability. In other words, just pumping up the dollar versus gold. And this was enabled by the COMEX adding thousands of tons of undeliverable paper gold into the daily trading mix, diluting the real deliverable gold price. Now, official gold price suppression maintenance always required a cartel of market-making bullion banks who, through position concentration, they were able to print as much paper gold as was necessary to control a rising global gold price. Now, well, if we now fast forward, and here we are, 54 years later, and we're recording this on the 20th, so 5 days ago, with gold price really in dollars 9,500% higher, averaging $175 per year, 175% per year, at around 3,300 at the moment, or 3,340 or whatever it is. Yet the real story is that gold has not actually risen in price. It's just that it requires 3,300 more dollars just to buy the same ounce, kilo, ton of gold. And what we're about to see is the next pivotal gold price revaluation event, which will once again incentivize every single foreign central bank to race again to swap more dollars to buy the same ounces of gold. Now, we'll look at the footprints that assure next year's Nixon shock anniversary, the 55th one, will come around with gold having been revalued against the dollar. So not only, really, what would my question be here? What is the question? How many dollars will it actually take to buy the same ounce of gold next year? So a similar 55th year, 175% higher physical price would price the dollar gold at around $8,000 to $9,000. Now, US gold price revaluation will first force US gold reserves to become Basel III compliant. So let's just say I wouldn't bet against that. Now, with most of Europe away on holiday over the last 2 weeks, vapor-thin liquidity has given the training advantage to the derivative actors in gold and silver. But while this leveraged supply has driven another opportunity for officials trying to mark as many of the, remember those Office of the Comptroller bets that have been putting up the charts about? So they want to mark as many of these bets because they relate directly to US Treasury reserves. They want to mark them to market as best as possible into first options expiry, into options expiry and first notice day on the 28th. So options expiry is next on the 26th and first notice is on the 28th. But under this short-term chart noise, let's drill down into the footprints which are ultimately leading to a real supply-demand gold price to emerge. Now, over the last 2 weeks of paper-driven tariff flip-flop, a series of gold revaluation footprints have actually been revealed. Now, cutting to the quick, ironically, almost to the day 54 years ago, with the dollar redeemability being usurped by the China yuan one-to-one Basel III compliant convertibility into gold. So you hold the yuan, it's backed by gold. The irony of it. And the COMEX diluted prices are being targeted through the back door Achilles heel, which is, as we've said multiple times, the exchange for physical mechanism, that little mechanism that allows for COMEX synthetic supply to move into the Basel III compliant markets for delivery. So yes, the accompanying dollar-based paper gold suppression tool that finally blew up, coming dangerously close to blowing up the interconnected $2 quadrillion dollar derivative markets, of which gold is the largest really the largest shoe to drop.
Andrew Maguire warns that recent futures-driven sell-offs in silver have backfired, exposing profound distortions in the price discovery process. Despite attempts to drive U.S. silver futures into a thin liquidity vortex, physical demand at $38 per ounce has been too strong to suppress. Options positioning continues to cluster around $37 to $38 as the sweet spot. Yet evidence suggests the Federal Reserve, working through its agent banks, is maintaining a short silver position to keep prices capped. These pressures are colliding with a much larger shift, with silver increasingly being traded on physical exchanges outside LBMA control, such as the Shanghai Gold Exchange. A genuine supply-demand price is starting to emerge. On these platforms, every transaction requires absolute ownership. Sellers must hold the bars they offer, and buyers must take physical delivery. The result is reduced volatility, cheaper hedging, and a transparent market where sovereign nations can accumulate silver at accurate market-based prices. Historically, however, the story was very different. The LBMA operated on extreme leverage, with up to 500 paper ounces of silver for every real ounce. This system, openly admitted by insiders, enabled bullion banks to dominate the market with synthetic, cash-settled contracts. Maguire argues that this stranglehold is now slipping, and with it, the ability of paper markets to dictate the global silver price. Let's get back to the interview.
That silver market paper settled liquidity, alongside producer financing initiatives, are rapidly leaching out into the Chinese-backed 7-second settlement BRICS-facing physical exchanges, where you have to own a bar before you can buy and sell it. Now, very short term, thin holiday market liquidity aside, in the larger picture, silver has largely escaped the LBMA stranglehold, opening up buyers from all over the world. Now, historically, up to 500 1-to-1 paper to silver position concentration, that is, yes, 500 paper ounces to 1 paper ounce of silver. That position concentration was admitted by industry apologists in the past, and it's enabled the LBMA silver cartel to have full control of the cash-settled, unallocated silver foreign exchange market. Now, these synthetic silver fixed prices have historically been so diluted with unallocated, undeliverable cash-settled silver contracts, they don't reflect a real price, whereas central bank sovereign buyer, which you refer to, where they could take delivery, it was just too volatile. And bearing in mind, the underlying leverage bars have diluted the real physical price. So absolute chaos. Now, the trouble with local London pricing, it's been so dilutive of the real physical price that 3 things really have come into play. Massive injected price volatility. And if that didn't dissuade a buyer from looking at silver as an investment asset class, if delivery actually was demanded, extremely large premiums over the spot fixed price had to be paid to obtain physical bullion. In other words, bilaterally settled, completely different, separately to what this ludicrous fixed price was. And this has made a farce of the global fixes. But even worse, very large physical orders have been refused, and we've experienced this in the past ourselves. Now, because a very small group of LBMA bullion banks controlled really the legacy silver market, they're no longer fully controlling it. And yes, we're talking about UBS, Deutsche Bank, JP Morgan, Scotiabank, and satellites. What they would do is they'd lock down the bullion banking arrangements with the refineries, alongside forward purchasing all the refineries' annual production. So any buyer seeking to backdoor it and circumvent the cartel, because it hit the banking network, there was immediately red flagged, warned, and then you'd receive a warning that you'd be blacklisted if you persisted in trying to take delivery. Now, however, with silver now being priced in real physical exchanges outside the LBMA cartel's influence, where a seller of a silver bar has to first own it and a buyer of that bar has to take physical ownership of it, a real physical price is beginning to emerge in the SGE benchmark exchanges, where it's now possible to buy any quantity of silver at a physically determined supply-demand price. And with volatility greatly reduced, hedging these purchases is far less expensive. And that makes it very attractive for other national currencies to invest in silver. And so, yeah, Kerry, just as revealed by Russia, which is, again, the eighth, I think we covered this last time, but it's the eighth largest gold producer. And they're aggressively stockpiling silver as a tangible reserve asset. With silver now available in any size for small nations to access, this largely unfactored real physical demand is going to drive a much higher true supply-demand price. It's just starting to evolve. The Loco London fix is still dilutive, but increasingly benchmarks a direct producer to end user price. So any discrepancies are being arbitraged. Now, LPs report continued accumulation of underpriced LBMA CME silver is currently in the BRICS crosshairs. So with US-driven silver futures, we just saw it again, while US silver futures got sucked into the thin liquidity vortex this past week. LPs indicate there's too much physical interest at spot $38 for it to be kept below. And obviously we saw because the options positioning suggests 37.30 as the option sweet spot, and that the Fed has a silver short position, OCC silver short position through its agent banks, you can darn well expect that they are behind, trying to market below. They don't have silver. They can buy gold, but they can't buy silver without disrupting the entire silver ecosystem. Now, of particular note, and far too obvious, was Tuesday's farcical futures-driven sell-off that waited until silver had fixed, and then synthetically drove the spot FX silver price trade into an overnight Wednesday, this is the Wednesday lows, 9-cent premium to backwardated silver futures. In other words, the spot premium was trading at 9 cents an ounce higher than the futures market price, literally making a farce of this whole futures market, this price discovery mechanism. It didn't go unnoticed, and it's been arbitraged, and there'll be a price to pay as very large buyers locked in these massive futures discounts for physical delivery. And just as we saw as we saw in August gold futures at its first notice, and the physical buyers coming in, evidencing the largest on record backdoor bullion loadouts in gold, this month, September silver expiry next week will also evidence massive backdoor loadouts. SGE, Indian and Saudi buyers use dollar strength to exchange for silver overnight, hence the 9-cent premium in spot. So despite all this faffing around, no damage done. All it's done is expose the silver futures backdoor for an enormous loadout. Here are a couple of really interesting silver observations. Here's a couple of links to look at. And both gold and silver futures are coiling into oversold conditions.
What stands out is that gold has not truly risen in value, but instead has exposed the steady decay of the dollar's purchasing power. From Nixon's 1971 decision to today's $3,300 price point, every move upward reflects not strength in gold, but weakness in fiat. Now the prospect of a sharp revaluation, potentially toward $8,000 to $9,000 per ounce, signals a moment where monetary reserves could be forced into Basel III compliance, shaking the very core of the financial system. Silver, meanwhile, is showing cracks in decades of paper control. A market once dominated by 500 synthetic ounces for every real one is giving way to physical exchanges, where every bar traded must be owned and delivered. sovereign accumulation is accelerating, premiums are widening, and the leverage that held prices down is being exposed for what it is. These aren't isolated developments. They are threads of the same unraveling fabric, where gold reflects the dollar's erosion and silver reveals the collapse of manipulation. Together, they point to a turning point already in motion, where real money begins to reassert its role against a debt-heavy, paper-driven system. If these signals continue to build, could the reset arrive sooner than anyone expects? So, stay tuned. If you value sharp, data-backed insights into gold, silver, and the monetary system, make sure to like this video and subscribe so you don't miss the updates. For more coverage on Bitcoin and related markets, check out our other channel. Thank you for watching.